Amazon.com Inc. is trading at $239.12 USD, showing an intraday move of plus 0.94 or 0.39% as of this moment on Tuesday, January 20, 2026. While the market sees a modest green tick, the underlying tension is far more electric than the price action suggests. You might look at this and see a stable tech giant, but the expectation from major institutional players has shifted toward a narrative of peak Amazon, while the reality on the ground points toward a massive, invisible structural shift in how the company extracts value from every single package it moves. Right now, the headlines are buzzing about billionaire investors like Philippe Laffont and Steven Schoenfeld trimming their positions in favor of Bitcoin ETFs. The expectation is that the big gains in big tech are behind us and capital is rotating into more speculative assets. But here is the development most retail investors are missing. Amazon is currently halfway through a massive logistics overhaul that is quietly turning its shipping business from a cost center into a high-margin service provider for the entire e-commerce world. If you use a Fidelity trading platform or track your holdings through a Fidelity mobile app, you have likely seen the volatility, but you may not have seen the data showing that Amazon's logistics arm is now outperforming traditional carriers in both speed and cost efficiency at a scale that was previously thought impossible. We often think of Amazon as the place where we buy groceries or gadgetry, but that is the old perspective. The common ground most of us share is the belief that Amazon dominates through sheer volume and low prices. I want to challenge that. The reality is that Amazon is becoming an advertising and infrastructure company that happens to have a retail front. Last year, their advertising business grew by double digits, and early 2026 data shows that sponsored listings are becoming more valuable than the actual products being sold. When you look at your SoFi Invest dashboard or check your individual brokerage account on Interactive Brokers, you are seeing a price that reflects retail sentiment, but the institutional money is looking at the margins. They are looking at how Amazon is using its internal AI chips, like the Trainium 3, to cut its reliance on NVIDIA stock and lower its own operational costs. Let's talk about the recent swings. We've seen AMZN fluctuate between $220 and $250 over the last few months, driven largely by fears of a slowing consumer and the looming threat of agentic commerce. Some analysts at firms often used for investment help have pointed out that if AI agents start doing the shopping for us, the traditional Amazon search bar might become obsolete. This is the tension. Will consumers still browse, or will a bot just find the cheapest price? If the bot bypasses the search results, Amazon loses that lucrative ad revenue. This fear is what kept the stock from hitting new all-time highs in late 2025. However, the reality we are seeing in the early weeks of 2026 is that Amazon is building its own agents, Rufus and Alexa Plus, to ensure they own the interface of the future. They aren't waiting to be disrupted, they are disrupting themselves. The trading volume today shows significant institutional activity, specifically from funds that specialize in Fidelity Wealth Management and long-term Fidelity mutual funds. These aren't day traders. These are the folks who see the 20% growth in AWS as the sign that the cloud isn't just a place to store data, but the literal engine of the next decade of software. While many people are distracted by the price of Tesla stock or the latest iPhone cycle affecting Apple stock, Amazon has quietly built a backlog of cloud contracts worth over $200 billion. This provides a level of revenue visibility that almost no other company on earth can claim. If you are using a Robinhood app or engaging in Robinhood stock trading, you might be tempted to chase the daily momentum, but look at the sector momentum. Tech is facing a bifurcated reality. Companies that can't prove their AI utility are being sold off, while those with the hardware and the data, like Amazon and the providers behind many Fidelity ETFs, are being treated as the new safe havens. The macroeconomic pressures of 2026, including shifting interest rate expectations and global supply chain rerouting, actually play into Amazon's hands. Their regionalized fulfillment model, which they spent years building, is now fully operational, meaning they are less exposed to global shipping shocks than almost any of their competitors. I want to hear from you on this specific point. Comment below how many shares of Amazon you currently hold and whether you think AI agents will actually replace the way we shop online today. Your perspective on the ground matters just as much as the charts. To understand where we are going, we have to look at what this business actually is today. It's no longer just a website. It is a three-headed beast, a global logistics network, the world's largest cloud provider, and a massive digital advertising firm. The retail side provides the data, the cloud side provides the intelligence, and the logistics side provides the physical reality. In previous years, the retail side was a drag on the bottom line, but in early 2026, we are seeing the results of the Amazon Business Initiative, where they are aggressively targeting the procurement systems of large corporations. This is a high-ticket, high-margin business that traditional retailers can't touch. If you are managing your own portfolio through self-investing or using investing sites for online investing, you know that the price-to-earnings ratio for Amazon always looks high compared to the S&P 500. It's currently sitting around 34, but that number is a mirage. Amazon intentionally suppresses its reported earnings by reinvesting almost every cent of free cash flow back into its infrastructure. They are building data centers in Thailand, Mexico, and New Zealand. They are doubling their cloud capacity by 2027. If they stopped investing and just let the cash pile up, their earnings would skyrocket and that PE ratio would look much cheaper. This is the classic expectation versus reality gap that separates the sophisticated investor from the casual observer. For those of you using a SoFi trading platform or interactive brokers platform, the fees and the speed of execution are important, but the quality of your thesis is what makes or becomes the difference. The thesis for Amazon right now is about operating leverage. For years, they grew by spending. Now they are growing by being efficient. The automation in their warehouses is no longer a pilot program, it is the standard. This means that for every dollar of revenue growth, a larger and larger percentage is falling to the bottom line. This is why firms like HSBC have raised their price targets toward the 300 level. They see the margin expansion coming from a mile away. Looking at the competitive landscape, interactive brokers' fees and the ease of use of the Robinhood app have made it easier than ever for new investors to enter the market. Many of these investors are focused on the Magnificent Seven and are constantly comparing Amazon to Nvidia stock or Apple stock. But Amazon is in a category of its own because it touches the physical world so deeply. You can't download a package. You need a truck, a driver, and a warehouse. Amazon owns those. This moat is becoming wider as the cost of capital remains higher than it was in the early 2020s. Smaller competitors no longer can afford to build the infrastructure needed to compete, which leaves Amazon and perhaps a few others as the only games in town. As we look toward the upcoming earnings report in early February, the market expectation is for a solid beat, but the real catalyst will be the guidance for 2026. If management signals that they are moving away from the heavy investment phase and toward a period of returning capital to shareholders, we could see a massive re-rating of the stock. Imagine a world where Amazon starts a dividend or a massive buyback program. That would completely change the profile of the stock from a growth-at-all-costs play to a mature, cash-generating powerhouse. This is a possibility that many who use Schwab Intelligent Portfolios or look for investment help are starting to price in. The risks, however, are real. Regulatory pressure remains the biggest shadow over the stock. Governments are increasingly looking at the gatekeeper status of the Amazon marketplace. If they are forced to spin off AWS, or if their advertising practices are curtailed, the stock would face a significant headwind. This is the reality that could fall short of expectations. However, history shows that Amazon is incredibly adept at navigating these waters, often ending up stronger after a regulatory fight. If you are using Fidelity IRAs or managing a long-term retirement fund through Fidelity Brokerage, you have to decide if you believe in the longevity of the American consumer and the continued transition of the global economy to the cloud. If you do, then the current price action is just noise. The intraday moves like the 0.39% increase we are seeing today are minor compared to the fundamental shift in the company's profit profile. Whether you prefer online investing through a SoFi active investing account or a more traditional interactive broker's account, the key is to stay focused on the cash flow. In summary, we started today with a price of $239.12. The market expects slow and steady growth, but the reality is that Amazon is undergoing a massive transformation into a high-margin service and infrastructure company. We've seen billionaire exits create a temporary